This program is for informational and educational purposes only. This program is not a solicitation or recommendation for any investment or security. Investments or securities mentioned in this show may or may not be owned by Nepsis Advisor Services. Nepsis Advisor Services is an SEC registered investment advisor.
Welcome to Journeys with Joni. My name is Joni Rametta, and here today I am with my co-host Mark Clark.
Good morning, Joni. How are you?
I'm awesome. How are you?
I'm awesome. It's great to be here today. I'm excited about the show.
I know. We have a special guest again today. Hopefully last week you listened and you actually heard Mark Pearson, our President and Chief Investment Officer, speak. And we promised to bring him back this week to go a little bit more in depth into some of the, last week we were talking about fear and greed.
If they missed the show, how can they go listen to that show, Joni?
If you missed the show, you can go to journeyswithjoni, JONI.com, news and events, and you can actually listen to the show and hear all the wonderful things that he had to say.
It was a great show.
It was a good show.
And we kind of talked last week about what we're going to talk about this week, which is
strategic cost averaging.
What a great word. Strategic cost averaging. But before we jump into the topic, we better say hello to Mark. We don't want to leave him sitting here.
So Mark Pearson is joining us from Minnesota. That's where he calls home.
Poor guy.
Yes, hello, Mark and Joni.
How are you?
I am outstanding. How about yourself?
We're good.
And Mark
Excelente.
He is the Chief Investment Officer, which means he makes the investment decisions and the president of Nepsis Capital Management and Nepsis Advisor Services. He's the boss.
The big guy, the boss.
We call him the big shooter.
Yeah.
You guys are too kind. I'm just a cog in the wheel.
Yeah. Well, we're cogs in the wheel, too.
So set him up, Joni. Strategic cost averaging. Set him up big, and let's see what he does with us.
Okay, so here's the scenario. I mean, and this is a real scenario, Mark. So,
yes,
had a client in the office today. Actually has a portfolio already existing that's basically made up of 5 or 6 mutual funds.
Okay.
About to retire in 2 to 2.5 years, and is like, what should I be doing, and where do you think things should be? And I said, well, the first thing is, do you know what you own in your portfolio and why you own these different mutual funds? And of course, the answer was no.
Yes.
So we talked a little bit about that, and then we talked about Nepsis Capital Management and your process of owning, 30 to 35 companies, having the transparency. Talked a little bit about the flexibility. So let's tell people, when I turn this portfolio over to you, let's just say it's $100,000 just for round numbers.
Yep. 5
different mutual funds.
Right.
We're going to select one of the buckets that you have. So we have 5 choices. We have growth and income, balanced, income and growth, and then income portfolio. So in this case, after speaking with the client about where they are and where they want to go, we selected the growth and income portfolio.
Okay.
So we're a couple of years away from retirement, so obviously we need this money to grow.
Yes.
So, and at some point in time, we may have to, do a little shift in the portfolio when we get closer to retirement based on, needs and financial needs and the financial planning. So when I turn this portfolio over to you, what am I going to see as he and I are watching what's unraveling with the transition from owning these mutual funds to owning the stocks that you have?
Right. Great question. Well, first of all, one of the benefits that we feel we provide to the client is that we don't necessarily, when money comes into our management stewardship, we don't just sell everything and then go put it into that growth and income bucket that you call it.
Mm-hmm.
We have a very strategic process. We refer to it as strategic cost averaging. And what we will do is, as we want to buy the businesses or the percentage we want to own of the businesses we want to put into that portfolio, we will sell portions of the mutual fund to raise the cash to get those positions allocated. Oftentimes, it may take a week, 2 days, a year. I got an email from an advisor this morning meeting with an income and growth client, and there's 45% of their money sitting in cash. And the advisor wanted to know what he should tell the client why the money's not invested. And that money is earmarked for bonds. And many people may know that last year, bonds had a negative, bad year. And at historical low interest rates, many investors don't understand the risk. So we left it in cash. Turned out to be a phenomenal decision. But we're not going to take the money and go put it into the investments just because we have a model that they need to have their money invested in. It's very strategic, and it is very time consuming, takes time to do it, and you have to have a lot of patience. That being said, one of the benefits that the investor has, of course, is that we don't have ticket charges. The cost of doing all the trades in the portfolio are built into their fee. And so we can do 10,000 trades in the account. It doesn't cost the client anything. And that gives us ultimate flexibility, Joni, to maneuver the portfolio when it's in the best interest of the client to put their money into the investments that we believe they should own longer term when it's appropriate.
And I think that's a big contrast to anybody who's listening to us that's ever, changed advisors or moved money. It's usually, they're invested in portfolio A today, and then tomorrow they transition it over and they're immediately invested in portfolio B, and they've really, turned around and bought things that are probably at a premium price. And,
right.
Last time I checked, most people like to go shopping when things are on sale.
Right. Well, that's why we like volatility. Here's the other thing you need to remember. That's very important. We're very focused on tax management. There's been studies done, actually, the baby boomers. This person is a classic example of that, where tax management of their portfolio is far more important than it used to be. And depending on when money comes into the account, depending on what they own, we also look at the tax implications of selling things in a given year. We may say we want to sell something and it's November 30th, but we may wait till January 1st to sell it, so that they don't pay the gains on that, the tax on the gains on that for another 15 months. Mm-hmm. Those are huge benefits to the investor. Those are the little things that investors don't think about. They just look at what's my rate of return, what's my rate of return. But the irony of that is that a return is not just a number. There are multiple components that are driven to that return that people aren't aware of.
You've opened up some opportunity to continue this dialogue in the next segment. I know we're kind of up against a break, but we were talking about something you wanted to ask him to share a story when we come back from in the next segment. Yeah. What was the story you wanted him to share?
Well, there's a story of actually an investment that was relatively highly priced, doing well, and then bad news came along and the stock price actually fell. Well, maybe plummeted would be a good thing to say, and exactly how you managed yourself through that process. So I think that's really important for people to understand that, things happen and we have a process and we have the clarity, we have the flexibility to do the things that we need to do. And that's exactly what you do. So when we come back from the break, let's
be a great story.
Let's have that story. So Journeys with Joni, JONI.com is where you can go to get information, blog site, nepsiscapital.com is where you can go and actually see the video that talks about how Mark does what he does. You can give us a call at 941-361-1484. We'd love to have a one-on-one meeting with you if you have any questions about how Mark actually does manage the money. So give us a call. Journeys with Joni. We'll be right back.
Do you know what you own and why you own it? Join us for our next workshop to learn about investing with clarity by calling 941-361-1484 to reserve your seat today. Joni and Mark look forward to discussing the philosophy, strategy, flexibility, and transparency, the 4 pillars of investing, with Nepsis Advisor Services. Call today, 941-361-1484. That's 941-361-1484.
Welcome back to Journeys with Joni. Just before the break, I sort of put a teaser out there, didn't I?
It was a great teaser.
Yeah.
Great teaser, Joni.
Thank you. Actually, in your portfolio, and we're talking about Mark Pearson, our Chief Investment Officer and President of Nepsis Capital Management up in Pennsylvania. Where did that come from?
I don't know.
I know.
It must be where that Mike guy is from a couple shows ago.
Yeah, that's probably true. Actually, I'm going on a trip to Pennsylvania in a couple of days. So I think
vacation on the mind.
No, it's not vacation. It's a football camp. Glory. Anyway.
Are you playing football?
She's trying out for the NFL. Yeah. She's a quarterback.
Nice.
She got a heck of an arm. Anyway, focus.
Let's get back, guys.
We had a cliffhanger story. Set it up.
We did. And so in the portfolio that you've been managing, you actually had a a company that we owned.
Yes.
That was a solid company.
Yep.
There was something that happened that made the stock actually go down significantly in value.
Yes.
But you did some stuff. So let's talk about, what did you do? What happened?
Sure. Well, first and foremost, as we tell investors, there's no individual one position in a portfolio that should make or break the portfolio. So from a diversification standpoint, we never want to own a business in the portfolio that has a substantial percentage. 5% is the max of any one company we will own. So under those auspices, what happened was this company was a 2% allocation of the portfolio. So the theory is that if that company went to zero, it had a 2% impact on the portfolio. Now, nobody likes to see a company go to zero that they invest in, but things happen, and that's why you diversify in the first place. And over the long term, frankly, 2 percentage points is not dramatic at all in a portfolio's overall performance long term. So this company, we started buying back in 2006 in the low to mid 40s. And ironically, it was a very nice dividend producing stock. The dividend yield at that time was about 7 and 7.5%. And of course, Mark and Joni, you have heard plenty of stories of investors lately chasing dividends in their portfolio because they're looking for income. Just because a company has had a dividend and a large dividend on a percentage basis does not mean it's going to continue to pay it. But in this particular case, this company was in the financial services business, and as the recession hit and we had the financial crisis, that stock went from about $45 a share and bottomed at 62 cents.
You said 62 cents, less
62
than $1.
cents. Yep. And we held on to it. In fact, I got several phone calls from people wanting to know, why would you hold on to a stock that goes from 45 to 62 cents? And I said, well, if you got a crystal ball that works, I'll take it off your hands for you, and we'll fix that problem right away. Of course, I've never seen a crystal ball that works like that. But you have to have a philosophy and strategy. And the irony of this situation was that the company fundamentally had not changed. They had assets. They were a well-run company, and they were just caught up in a short-term issue as it pertained to the financial crisis. So our clients who started buying that stock with an average cost of about $42 to $45 a share, we started buying that stock coming out of the recession at about $2 a share. And we bought a boatload of that stock at 2, 3, 5, 7, 9, 10, 12, 15. And ironically, at $5 a share, the company paid $1 dividend in shares. So $1 on a $5 stock is a 20% dividend paid out in shares at $5. Mm-hmm. When we exited that company, we exited in 2013 for various reasons. The stock we exited out of was at about $14.50 a share. When we went back and looked at the average cost of the client who owned that stock, and depending on when they bought, of course, the clients who got in it at $2 a share made lots of money. But the clients who got in it at $45 a share and watched that stock go from 45 down to 62 cents, their average rate of return per year over the 7 years they held that stock was between 12 to 17% per year. Now, I show that story, and we have it in a spreadsheet form, and I've shown that to investors often, and they look at that and say, how is it that you made money from a stock you bought at 45 and you sold it at 14? How did you make money on that? That is the power of flexibility and strategic cost averaging. The ability to buy more of a business without impacting the total portfolio on a dramatic basis and providing terrific returns into the portfolio by continuing to buy that stock while it's beaten up. And obviously, investors need to be patient, but understand that the percentage owned of that position in the portfolio was less than 2%. And so the impact of the overall portfolio is more important than any one individual position. And it's a powerful story.
And I can imagine, and I experienced this because we were working together at that time, the people who were concerned about it, falling and forgot that it was only 2%, as you're coming back through and you're doing a good job of sticking to the knitting, those are the same people who probably said, man, I wish this were 50% of my portfolio.
Yeah.
Doesn't work either. You have to stick to the knitting and stick to the game plan, which is one of the things that has been, in my opinion, one of the more powerful things that we've had that's impacted our clients is sticking to the knitting, not chasing the rainbows.
Yes.
And strategic cost averaging into this. And, the last segment, Mark, you stepped into some tax management when it comes to strategic cost averaging. And I know we're getting close to a break here in just about a minute and a half, but I want to talk about that a little more in the next segment. We've talked about that in previous shows, haven't we, Joni?
We have tax management.
The tax management. I think it's very important because one of the things in tax management is when you save somebody a tax dollar, that's not reflected anywhere in the investment return section of when they're looking at their portfolio, their statement.
Correct.
And that is very, very powerful. A dollar you keep in your pocket and not sending to Uncle Sam is exponentially great for you, but it doesn't show up on paperwork anywhere. So
correct.
We referred to portfolio analysis. If they want to jump in and have one of those free portfolio analyses done or interact with us or even have an opportunity to have Mark talk about your portfolio, how do they find us?
You can find us at Journeys with Joni. That's JONI.com. You can there's a link that you can actually email me. All we need is the portfolio that you have, and we can create that portfolio analysis. You can give us a call at 361-1484, and you can come by the office at 6230 University Parkway. We're in Suite 305. That's the Home Bank building. And, I got to say that, the way that Mark manages this, and even through these difficult times with this market volatility, and, we have good days and bad days in the market, it's really rest assured for me as an advisor for my clients that he sticks to the knitting. We know exactly what's going to happen. We can watch it happen. So when you're watching your own money, understand that I'm watching your own money too, and I'm watching what's happening. And, there's a sense of,
peace.
Peace. Yeah.
Clarity.
Definitely. Clarity. Exactly. So, we know what's going on. We can see what's going on, and we understand what's going on. Journeys with Joni. We'll be right back.
Do you know what you own and why you own it? Join us for our next workshop to learn about investing with clarity by calling 941-361-1484 to reserve your seat today. Joni and Mark look forward to discussing the philosophy, strategy, flexibility, and transparency, the 4 pillars of investing, with Nepsis Advisor Services. Call today, 941-361-1484. That's 941-361-1484.
Welcome back to Journeys with Joni. We are so glad that you're listening to us today. We have with us Mark Pearson, our Chief Investment Officer and President of Nepsis Capital, and Mark Clark here in the studio with me.
Yes, we're having a good time. I know they're having a good time in Minnesota as well because it's summertime up there and they're not getting snowed on, which is I'm always
easy, fella.
I'm always harassing them up there.
Easy.
It's always nice when we get those emails from there. When we get somebody in the office up there, Mark will send us one of those pictures of all your snow.
Yes.
Yeah, we sent a picture. Isn't it? We have snow.
Brings a tear to my eye.
Yeah.
Not the kind of tear you think.
Yeah, I know.
Wondering why I'm not down there.
Well, you can come visit us anytime you want.
Thank you.
We got snow on the beaches here, so it's always a good place to come visit. But before the break, in this show, we've been talking a lot about the strategic cost averaging and how volatility is our friend, because we have a strategy and a philosophy. But we started to talk a little bit about tax management and how that's used in your making decisions in the portfolio through the strategic cost averaging. So let's talk a little bit more about the tax side of it, because, anytime we can keep $1 in our pockets or in our accounts, it's a good day.
Absolutely.
Yes.
And I think it's one of the keys, kind of setting it back up, your case study, if you will, for today's show was a mutual fund portfolio coming over to the Nepsis management in the 25 to 35 companies, stocks that we want to own. And Mark, speak to the tax efficiency of how you tax manage the transition of where they are to where we want them to be, and then kind of elaborate a little bit on, I'm sure in your repertoire of stories, you have some tax stories that I think people would find very intriguing.
Sure. Well, first of all, it obviously, depending on when the money comes to Nepsis to manage, may alter tactically a little bit what we do just because of the time of the year. Obviously, having that flexibility alone is tremendous. And the idea that actually the money, the firm that is managing your money is conscientious about tax implications of the portfolio. And I always tell clients, it's not a bad thing to pay taxes. It means you made money.
Exactly.
The question is, how do we pay as little tax as possible while not jeopardizing the quality of our portfolio, the quality of the investments we have? And so often I'll tell people, there's a bunch of companies that we own in our client portfolios that frankly we'll never sell. And when you think about, when you own something for 10, 20, 30, 40 years and it never gets sold, of course, the tax law allows for a stepped-up cost basis at death, and I realize when you're dead, you don't really care, but your heirs may, and the amount of money that can be saved from a tax standpoint can be substantial. But back to the original question and the story regarding the new client, when that mutual fund portfolio came in, when those assets come in the door from any client, we're going to assess where we are within the market, the valuations of the companies that we want to own versus the mutual funds that are coming in and what they are invested in and why they're invested in. For instance, we've had new portfolios coming in. We're selling the bond funds fairly quickly out of those portfolios because of where interest rates are right now. That flexibility of what's going on with interest rates, the flexibility of what's going on with the stock market and stocks that have volatility enable us to focus on what kind of gains or losses one has in their portfolio and how we can best maximize the portfolio return while minimizing risk. That being said, the story that Mr. Clark may be referring to is a portfolio that we had brought in November of 2012. And bear in mind, I'm not saying the size of the portfolio to brag. I'm telling you because of the impact of this. But this was a $15 million portfolio. And we sold every position out of that portfolio and reallocated that portfolio into the Nepsis models. That took 7 months. And over the course of the first quarter, second quarter of 2013, we made a lot of our moves. When that client ended 2013, they had a capital gains bill of $140,000. Now, many people may say, $140,000, wow, that's a lot of capital gains. Not on a $14 million portfolio. Not only that, the client took out over $2.5 million over 2013. So when you think about strategy of strategically cost averaging into businesses and out of businesses to give the capital to the client that they want to spend, the ability to efficiently and effectively manage around the tax implications of that coming out of it with let's call it a 1% of total portfolio value taxable is off the charts. And needless to say, the advisor and the client were more than ecstatic about that. That's the power of flexibility. That's the power of tax efficiency and tax management of a portfolio in the process.
Mark, I think that's a great story, and I jotted down this note. And the note is taxes don't drive the investment decision. And I think
absolutely
we've bumped into people over the years that have said, I'm holding on to this investment. It's not doing so well, but I have a huge tax issue. And I know we're at the end of this show. I know we're running out of time. We're kind of opening up that Pandora's box again. But very quickly, in 20 or 30 seconds, just elaborate a little bit on that person who's sitting there. It's going, I'd love to make a change, but I got a tax issue and I'm stuck.
Well, I would say you're not stuck. What's happened in the past is the past. There's nothing you can do about it. If you've got gains, don't be ashamed and don't be afraid to take gains. You never can apologize for making money. Never have to apologize for making money. And whenever you make an investment decision, and this gets into looking at historical returns and why that's not a prudent idea, the past is the past. What you have to do is assess your capital now and assess the best business opportunities available for your capital for preservation and growth of that capital now and into the future. And if there are better options, There is nothing wrong with locking in gains on an investment, reallocating that capital, and looking for future opportunities to maximize your returns, minimize your risks, and take advantage of those opportunities. Obviously, no guarantees. That's where the philosophy and strategy, the flexibility and transparency become more important as the foundation of your investment process.
So to our listener who is identifying with this and saying, man, I'd love to go deeper. I don't want to make any commitments, but I'd love to go deeper. This is a great opportunity for you to get a hold of us. I know we're running out of time here, and Joni, you're going to give us the contact info. This is a great opportunity. We can include Mark in the team, include him in the conversation, Skype him in, even though he's in God's country, Minnesota. But he's part of the team, and we can interact with him. But how do they find us? And they can check out some of our workshops we've got coming up, Joni. So, Mark, thanks for being here. And I know I've cut us short on time, so my bad, Joni.
Yeah, that's it. Thanks for joining us today. Mark, thank you very much for spending time with us today.
Thank you for the opportunity.
You can find us at Journeys with Joni, that's JONI.com, or give us a call at 941-361-1484. Journeys with Joni will be back next week. Until then, thanks for listening.
This program is for informational and educational purposes only. This program is not a solicitation or recommendation for any investment or security. Investments or securities mentioned in this show may or may not be owned by Nepsis Advisor Services. Nepsis Advisor Services is an SEC registered investment advisor.